UNH was down almost 7% after market open. It has come back slightly, down 4%, and just over the last week it is down over 6%. This is one I do hold in my portfolio. I continue to add, and we can see Wall Street have given this a very strong buy rating with a lot of upside that we will cover in today's episode. We also want to look at exactly why the drop is. Now we'll take a look at this in more detail, and we'll also touch upon how they performed in their latest earnings, one of the reasons why we are very bullish on them in the long term. And as always, we're going to run through their very strong financial metric, not just their dividend safety, which is very, very safe, but also looking at essentially movement, insider buys, insider sells, as well as institution movement over the more recent quarters. We'll also take a look at how this company continues to increase their top line year on year, as well as their bottom line income. And we also want to take a minute just to look at the health of this company, their total cash versus their total debt. As always though, importantly as well, we want to run it through the valuation model. We want to get to our own intrinsic value. We want to see what our acceptable buy price is and what sort of margin of safety we are looking at, as well as Wall Street, and see what they forecast for a company that they do believe to be a very strong buy today. Now let's start off right now by seeing why exactly there was such a substantial drop for this company, and we can see the reason for it being a disturbance in the Medicaid business. Now what this exactly means, there is no clarity around it, but from their 40th annual strategic decision conference literally not too long ago, we can in fact see that an executive, yes, not the CEO, but said that UNH, in terms of Medicaid, they have a very prolonged redetermination cycle, and one of the things that he talked about, which was highlighted, is that there is going to be some disturbance around that, and that the company are taking a look. Now, more detail on this we don't currently have, so it does look like a possible overreaction by the market. But as always, we are going to take a look at this company to understand whether or not it does look very undervalued, and like Wall Street, a very strong buy for our portfolios. Now, in terms of over the last year, what we can see, this company has been pretty much flat, up 0.58%. Over the last 10 years, though, if you have been a shareholder, you would be up over 500%. Now, remember two things. One, if you were reinvesting the dividends, you would be up slightly higher. And the second is that it has outperformed the S&P over the same time. Now, in terms of the current trading price, we do see it is in the mid to lower end of the 52-week range. We do see a forward yield of 1.49%. Now, that may be a little bit slow for some investors, but we'll take a look at the very nice dividend increases year on year, and a forward P 18.19. It is lower than the S&P 500, which sits at today at around 22. Now, before we look at the numbers, we just want to point out from their earnings report last month how this company has performed. Now, if you do remember, there was some fallout from the cyber attack on one of their subsidiary companies. Nonetheless, though, they reported some very strong numbers like they typically have done, and we will touch upon the historical performance as well. What we know, the earnings per share, $7.16 versus the analyst targets of $6.61, and revenue around $100 billion, as we can see here, $99 billion expected. So very, very strong numbers, a double beat. That is really all we wanted to touch upon, but just to say that this company is a very strong one to consider. In terms of their numbers numerically, then we'll start off with their total revenue. 3 to 7%, a very minimum number that we want to look at on a baseline. $130 billion in 2014. They reported nearly 3 times growth in their more recent year. December 23, $372 billion. So a very large company. Graphically, this is what you want from any company. I do suggest that any company you own or any that you're looking at, you do make sure that they are increasing their top line revenue consistently year on year. Although you could give essentially some reasoning for a drop, for example, COVID one-off events. In terms of bottom line, $5.6 billion, well, they have essentially quadrupled it. As we can see, $22.4 billion in December 2023. And as we can see, net income over the longer term, in line with the increase in revenue, consistently moving upwards in the right direction. Now, you may be surprised to hear that, but if you do look at a lot of companies, not every single one of them does have consistent increases year on year. We then look at the health of this company, their cash versus their debt. What we can in fact see here, their cash and equivalents, $7.5 billion in December 2014, $28 billion in their latest quarterly report. So over the longer term, their cash position is also increasing, a little bit inconsistent year on year, but over the longer term in the right direction. As always though, as we say, it is a bit of a number that is not that important in isolation. That is why we do compare it to their total debt. And what we can see both numerically and directionally, it has grown quite significantly over the longer period, 17.5 billion to 74 billion. As we can see, like cash, which has been increasing, so has their total debt. Something that we will consider when we do look at their dividend safety, as that is important to understand if they can continue those nice increases we love to see. In terms of their track record, well, very positive. The last 4 quarters, they have beaten double digits. As we can see, 29 cents in just the more recent quarter, so 100% track record, always very, very good sign. Moving forwards, they anticipate high single-digit growth year on year to the earnings per share, so again, another positive sign. And we do note their earnings per share estimate for 2024 does give them a forward P of around 18. If they do hit what they anticipate for the next full year, it is sitting around 16.25. So lots of positives, but as always, you do need to take a look and do your own due diligence. Next thing we do look at is the valuation grade. Currently scores an F. Now, this isn't one that I would agree on, as there are a lot of different valuation metrics, but in any way, we can jump straight in. 18.19 on a P non-GAAP basis. As we can see, it is in fact a discount of around 7% to the sector average of 19.48. But as always, there are different valuation methods if you do want to take a look, whichever ones you want to use for your own analysis. Overall, they've given it an F, not something I agree with, probably more in line with a B- when you do compare it to others in the sector, but again, for your information only. We then take a look at their growth grade. They get a C+. Now, when we take a deeper dive, their top line revenue increase year on year, 13%, a lot better than the sector median of just under 7%. Forward looking, pretty much 10%, again, better than the sector at around 8.86. And when we look at other ones, we can see they aren't too far off the sector. One that I do like to put my attention on is the earnings per share, increasing anticipated of 10% year on year over the next 5 years. As we can see, a little bit higher from the sector median, around 11.08%. This then brings us on to the profitability, looking very strong if you look at the overall grade. Gross profit, however, it is a lot lower, 24%, sector median at 57%. But at the bottom line, we do see 4%, very positive. This essentially shows us the majority of the industry don't turn a positive net income. Lots of companies with a net loss. So already off to a very good start, picking a very strong company out of the sector averages. And cash from operations, nearly 14 billion. And as we can see, a lot of them in this industry are struggling. And in terms of a conclusion for this part of an analysis, a buy rating from Seeking Alpha, a strong buy from Wall Street, a hold from Quant, valuation F, not one I personally agree with, growth C+, profitability A+. As always, as we go along though, do let us know your thoughts below. We then move on to a comparison. Others have also been falling today: Elevance Health, Humana, Centene Corporation, Molina Health, and a few others. Now, total return, including reinvesting those dividends, UNH, pretty poor performance over the last year. In fact, we can see not a lot of them have been performing just poorly, just UNH, as we can see in Humana. Elevance Health actually looking not too bad, the same as the others in the same industry. When we expanded over the last 5 years, we actually see UNH one of the better performers, the second best at 114%. And when we expanded over the last 10 years, again, we do see it up there, the top 2 best performing, 605%, which is very strong. And as we said, outperforming the S&P 500, one of the things that we do quite like about this company. But remember, the past performance doesn't mean they'll outperform the S&P moving forwards as well. So always do think about this when you are taking a look at your own analysis. In terms of insider ownership, well, 0.33%. We do note 4 instances of insider selling of 107 million, although you would have to go back to quarter 1 to see around 1 million worth of sales. Quarter 4, we do see a large amount of sales. When we look at exactly who these insiders are, we do in fact note that the EVP sold over 1,200 shares around the current trading price. As we can see here, right now it is looking around $482. And as we can see, pretty much right at that level, $600,000 worth. Remember though, whether or not you include this in your own analysis, bearish or bullish signal, that is completely up to you. And we tend to ignore the US Congress member trades, but again here, just for that transparency. We then take a look at institutional ownership, 88%. We see 59 billion worth of sales, with a lot more buying over the last 12 months. Now with our updated data that we have, we can clearly see in the first quarter of 2024, institutions were selling more than they were buying. First time we have seen this in quite some time. In fact, in all of 2023, we saw the opposite, more buys than sells. Something just to bear in mind, yes, over the last 12 months, a lot more buying than selling, but in the more recent quarter, more selling than buying. As always, this is just for your own information. Never really copy what these insiders do. Now, before we look at the underlying metrics, just to let you know, just a couple hours ago, we released our latest free weekly article. If you want to gain access to this or any of these other articles, all completely free, do click on that pinned comment below. You will get instant access. And one of these articles here, how to find undervalued stock, for those that are interested in knowing the websites and resources you use. We also look at 20 undervalued stocks to consider for your portfolio. And in the more recent episode, we do take a look at the best recession-proof stocks for those that do believe a recession is near, or for those that do want some protection in their portfolio for the longer term. So let's jump into their dividend safety score, 99, very safe, the highest score obtainable, market cap 464 billion, a mega cap company. And we can see just a few weeks ago that a very safe score was reaffirmed, meaning a dividend cut is highly unlikely. Now, last recession, they in fact maintained their dividend. They didn't increase, didn't decrease. What we do know, above average growth, plus 5% versus the S&P's negative 12. And in terms of recession return, negative 63, the S&P during the same time was a little bit better at negative 55. One thing I love about this company, those double-digit increases that we come to see, 14% last year, 16% over the last 5 years, 20 years, 41% on average increase to that dividend. Lots of positives to take here for dividend growth investors. Now, they have been increasing those dividends for the last 14 years, although paying a dividend for the last 31 without a reduction. Now, in terms of dividend yield theory, for those that are new, it does state the company is undervalued when the current yield sits above the 5-year average. Right now, what we see is an undervaluation signal. We also see that on the forward P, 17 versus the 5-year average of 20. So a double undervaluation signal. Just bear in mind, we're not looking at any of these models in isolation, and we will conclude towards the end. We also know the healthcare sector P, it does sit a little bit lower at 15.5. Now, one of the reasons they can offer those double-digit increases is because the free cash flow payout is very, very low. Typically below 60% just for that exact reason, so they can offer us double-digit increases, and it has in fact been below 30% over the longer term. 26 in 2023, 28 expected next year, so no worries in our opinion that they will be able to continue to offer those very strong growth dividends. In terms of earnings payout, not one we do focus on. It is susceptible to manipulation by management through accounting. If you're a regular viewer, you know we always want increasing free cash flows, increasing revenues. A lot of these metrics, year on year, we want to see growth. Now, they have done that over the longer term, but what we do note is that over the next 12 months, they do anticipate it to be a very marginal decrease, so something to factor in. But historically, even when we can see in the patch in 2015 to 2016 where it was flat, it continued to increase. Again, the trend was there in 2020, 2021, and again, it continued to move in the right direction. Sales growth, 3 to 7% as a bare minimum, pretty much double digit for the large majority of the last 10 years. Last 3 years, very strong. Trailing 12 months, 13% as well. Lots of positives to note. In terms of sales, we did cover this already, so just another format. They're not a massive company that do a lot of share buybacks. We can see, though, over the longer term, they have bought back roughly 53 million worth of shares. Still better than nothing as an investor. In terms of ROIC, return on invested capital, you do really want, for me anyway, 10% or more, just so you give faith that management can, in fact, effectively allocate their capital. We do know consistent numbers year on year, pretty much 19% over the last 5, 18 on a trailing 12-month basis, so very attractive to those investors. Now, in terms of operating margin, I do want to see 12% or more. The only thing I would say is that they consistently around the 8 to 9% level. So given this has been working for them over the longer term, this is one that we would like to see at a bare minimum stay consistent. If it does drop any lower, maybe something just to take in mind. Free cash flow margin looking fairly healthy around the 5 to 7% level. It has dropped on a trailing 12-month basis, so something just to consider, and we will take a look at this with their latest earnings over the next few months. This brings us to the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. With these numbers that you see below being the number of years it would take the company to pay off all of their debt net of cash on hand. Below 3 is the target, pretty much below 2 every single year. 1 in 2023, expected to go a little bit low into 2024. So we can already see with United Health that essentially their balance sheet is very strong. The dividend does also look to be safe. And this brings us on to the valuation model. As always though, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Multiple valuation model is the first one. We have the P multiples and the average of those in a similar sector and size. We did cover these earlier on. The earnings per share multiplied by the average P, and we do get an intrinsic value here showing overvaluation with the market value a lot higher. Just remember though, we don't look at any of these models in isolation. We then move on to the dividend discount model. We have the yearly dividends. Average growth rate just under 16%, so we have gone 6.75 forward looking, lower than both the average as well as the last few years. And what we can see based on this, we get an intrinsic value showing some severe undervaluation. We then move on to the discounted cash flow model, free cash flow year on year. Average growth 17%. Now we've gone a lot lower than not just the average, but also the last more recent year and management estimates. So at 7% with a discount rate of 8, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and again a second undervaluation signal. So in today's episode, 2 undervaluation signals and 1 overvaluation, with the intrinsic value coming to $562, the average of the 3 that you see on screen. Now do remember, you can grab a copy of this model if you want to run your own companies to get your own acceptable buy price and intrinsic value, whether that's UNH, other ones in your portfolio, or those on your watch list. Margin of safety, then we do start off with 10% and we do execute if it meets our 3 golden criteria. So you would buy at $506 if you believe it met the criteria of a wide moat, strong financial metrics, and good forward-looking data. And then we keep going till it's near the current trading price. And we can see in today's episode, it does have a 15% MOS level, around 478. Now, as always, it will depend on investors whether or not they do believe a company like UNH has that quality to deserve a 10 to 15% MOS level. Maybe some people will want more. Maybe some people will be satisfied for 10%. In terms of Wall Street and their expectations over the next 12 months, well, they believe the share price will go higher than our intrinsic value, $571, upside of 19%. So they do believe this is one to severely consider for your own portfolio. But as always, do let us know your own thoughts in the comments below. As I mentioned at the beginning of the episode, this is one that I have been buying. It is one that is in my portfolio. A lot of the metrics do look very strong. And with the news that we saw today in terms of why the company has crashed down around 6%, or in fact 7% at the beginning of market open, it didn't look like there was anything substantial there to really put someone off. But I'm always interested to hear your thoughts. Maybe you've added to this. Maybe you've added to others in the healthcare sector that are down. As always, though, if you enjoy the content, do smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.